With the Federal Reserve expected to cut interest rates for the first time in over 4 years, the interest on high yield savings accounts is sure to follow suit. And many people like yourself might be wondering what to do. But don't panic, there's three options that I'm going to cover in this video for what to do with your high yield savings accounts when the Fed cuts interest rates. Before we dive in, let me quickly explain why this even matters. So, when the Federal Reserve cuts their federal funds rate, banks typically follow suit by cutting the rate that they charge on loans as well as what they pay on deposits, such as a high yield savings account. So, while this is good for borrowers, for example, people looking for mortgages, it's not as good for those people with high yield savings accounts who have essentially been getting a free lunch for the past few years with those high interest rates. Nonetheless, this could be a great time to reassess what to do with the money in your high yield savings accounts, and which option is best for you will depend on your unique goals and situation. By the way, if you're new here, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. This channel is dedicated to helping you optimize your finances in all stages of life, as well as prepare for retirement. So the first thing you can do when interest rates drop on your high yield savings account is actually to do nothing. Remember, the purpose of these accounts should be liquidity or easy access to the money in the account. Think like an emergency fund or any planned expenses like vacations that are outside of your regular budget. But the interest rate that you receive on this money in your high yield account should just be the secondary benefit or the cherry on top. So just because you're getting paid less interest doesn't mean the primary goal of this account is changing. A common rule of thumb that people go by for how much they should have in their high yield savings account for that easy access is 3 to 6 months worth of your living expenses. I typically might recommend more than that, maybe 9 to 12 months for people who are working in an industry that has less job security, or if you're single, don't have a dual income household, you might consider keeping 9 to 12 months worth in there. But beyond that, I also typically recommend people that I work with keep money in a high yield savings account that they plan to spend in the next 12 to 18 months. Things like vacations, down payments on homes, things like that, that you plan to spend in the near future and should not be invested in anything more risky. But again, the point here with option one of doing nothing is just to remember what your purpose is for that account. And most of the times it's for liquidity and that easy access in the case that you need it. Second option you have is to shop around for better rates, whether it be in another high yield savings account through another bank that's offering a slightly higher rate, or you could look into alternatives such as CDs or treasuries. Keep in mind, CDs, treasuries, and other bonds typically allow you to lock in an interest rate, but they require that you keep your money invested for a certain period of time. So these might be best suited for future expenses that you already have planned. For example, if you plan to buy a home in 2 years, it might make sense to buy a 2-year CD, lock in that higher interest rate, rather than keeping it in a money market account where you're going to eventually be earning less interest. Before we move on to option 3, if you haven't already, do me a favor and like this video and subscribe to the channel so you stay up to date on any future videos. So after reassessing how much you actually need in your high yield savings account for emergency savings and other short-term expenses, as well as potentially locking up money in a CD or a treasury bill, option 3 would be to consider investing that money in more risky assets like the stock market if you don't need that money for a longer period of time. So for example, if you have excess cash in your high yield savings account just because you're enjoying that guaranteed 5% or more rate of return, it might be a good time to consider investing the excess of that in the stock market for longer term goals, because historically speaking, the stock market has provided much higher inflation adjusted returns over the long term. So for example, since 1926, US large cap stocks have returned an average annual return of 7.19%. That's after adjusting for inflation, whereas cash, such as high yield savings accounts and money market accounts, have returned about 0.31% on average after adjusting for inflation. So that can make a huge difference over the long run. Of course, investing in the stock market does come with short-term volatility, which I always like to say is the price you pay for those higher returns. So as long as you can stay committed to a long-term plan, generally speaking, the stock market will reward you long-term for those longer-term goals. You have a few different options for any excess cash that you do want to invest in the stock market. You can invest it in a regular taxable brokerage account, which is a non-retirement designated account, but generally offers a lot more flexibility as far as accessing that money whenever you need to. If you do want to fund something like a Roth IRA or a traditional IRA, those do have income limitations to keep in mind, but generally offer better tax benefits. Hopefully that gives you something to think about with the Federal Reserve getting ready to cut interest rates for the first time in a while. If you can think of any other ideas, be sure to leave them in the comments below. Besides that, thanks for watching, and we'll see you in the next video.